What's going on, everybody? Shiraz Ahmed here, and in today's video we're going to be talking all about financial strategies that you can take advantage of, but only if you're a couple. Now stay tuned to find out more, and please remember to subscribe to stay in touch. Alright, welcome back. So Shiraz here again with another video for you all. Now this advice is going to be specific to Canada, and it's true regardless of whether you're married or it's a common law, and it really doesn't matter whether it's a same-sex partner or not. It's kind of all the same. You may find that some of the ideas that we're talking about today being implemented in the US, but the details will likely be a bit different. So please remember that this video is not a replacement for sound financial advice from either your primary financial advisor, your CPA, your lawyer, or any other professional. With everything, if you're ever unsure, please seek out professional counsel. All right, so with my obligatory disclaimer out of the way, there are a lot of different strategies that are out there. So today we're going to be focusing in on actually 3 of some of the more common strategies that we see couples using in our practice. All right, so in the number 1 spot is the use of spousal RRSP accounts. An RRSP is a retirement savings account in which you can reduce your total amount of taxes that you owe at the end of that current year that you make a contribution. Now, everyone has a max dollar limit that they can contribute, and normally you would make that contribution into your own individual account. Now, if you're married, you actually have the option to doing the exact same deposit, but instead you can actually deposit the funds into the account under your partner's name instead. Now, this does not affect your spouse's RSP limits, but it actually does reduce your own. Now, why would you want to do this, you might ask? Well, it's actually the same reason really for all of these strategies. It's all about equalization of retirement income. Again, I'm not going to go into all the details here, but here's the basic idea. Imagine that you have a total household income of, let's just say, $200,000 in retirement. Now, if that income is attributable to each spouse, let's say at $50,000 or $100,000 each, the total tax in that household will actually end up being less than if only one partner was bringing $200,000 in income and the other had zero. The reason for this is that we actually have a graduated tax rate that we use here in Canada, and the taxes as a percentage go up as your income goes up. All right, so the second strategy that we're going to talk about is pension splitting. So this option is probably most used strategy with current retirees, but as more and more companies move away from defined benefit pensions, I think we're going to see the strategy used a bit less going forward. Now, CPP or Canada Pension Plan can actually be shared, but it has its own set of rules and guidelines, and that's really an entire topic of its own. And the OAS, unfortunately, cannot be split, and neither can retirement income from, let's say, an IRA. I know I said that we're going to be talking about Canadian rules only. This is a freebie for those of you cross-border folks or Canadians that have US assets. As a result of these rules, we'll mostly be talking about private pension plans here. Now, the basic idea is the same as before. It's all about equalizing your income in retirement. You can split up to 50% of eligible pension income on your partner's tax return instead of your own. Now, this is different from survivor's pensions. Now, survivor's pension is where a certain percentage of your spouse's pension continues to be paid out to you even after their passing. All right, and strategy number 3, spousal loans. Now, this strategy is probably the least commonly used of the 3 that I'm going to talk about today. The reason is that it only really makes sense to do this when you have one partner who has an extremely high income, and while the other partner or spouse has little to no income. We sometimes see this in couples where, let's say, one partner might be a doctor, a lawyer, an executive, or something like that, and the other partner may be a stay-at-home parent. This can cause a huge disparity in taxable income, where the working partner could be earning hundreds of thousands or even millions per year, while the other spouse earns virtually nothing. One way to help offset this is to set up what's called a spousal loan. Now, this basic idea here is that the higher income spouse will loan money ultimately to the lower income partner at a relatively low interest rate referred to as the prescribed interest rate. The lower income partner will then invest these funds on their own name. Therefore, they're going to be responsible for all the taxes and income that the portfolio ends up generating. Now, as long as the markets return more than the prescribed interest rate, which isn't always necessarily true, the lower income spouse will then be able to make money overall, but will pay less taxes on those gains than, let's say, the higher income partner would have. I say this is a less commonly used strategy only because it only makes sense if you tick literally every one of these following boxes. You have a very large income disparity. You have a large non-retirement or non-registered account value. This also usually means that you have all other accounts like RSPs and TFSAs already full to their maximums. Now, it also requires you to have an acceptable level of risk tolerance. Anytime you borrow money to invest, you're ultimately increasing your risk. So this might actually not be suitable for everyone, even if it ends up reducing some of your taxes. So how do you know when to use these strategies, etc.? Well, typically, whenever I meet with a client or family, we might be able to identify fairly quickly which one of these strategies might make sense. But the truth is, the best way to know for sure is to actually run the numbers and compare your different options and see which set of variables produces ultimately the best result. And the only way to really do that is with some typically specialized software, and generally you'll need someone to operate such specific software. And they also need to be familiar with all the rules and regulations and tax codes, etc. that go along with it. But they also need to be familiar with all the rules and regulations regarding RSPs, income splitting, tax codes, etc. So basically, in a nutshell, what I'm trying to say is that you need to get a financial plan done. Now, without running the numbers and finding out the most ideal split, the simple fact is that you might actually be leaving money on the table and paying taxes that, if you had actually planned properly in advance, you might actually not necessarily have to pay. All right, thanks for staying until the end of this video. What I'm going to do is I'm going to put my contact information at the end of this video. If you have any individual questions or concerns about your own circumstance, or even just topics that you want to see me cover, please feel free to send me a note and I'd be happy to address them for you. If you appreciate the content that I've been creating, please consider hitting that like and subscribe button, as it really does help out the channel. And until next time, please stay safe out there, you guys. Bye for now.